Hello and very good evening, everyone. My name is Sumit, and in today's presentation, I will walk you through the discounted cash flow valuation method as applied to real estate valuation. And in this presentation, we will learn what exactly this discounted cash flow valuation is and why is it the best valuation method out there among other valuation techniques which are quite popular in professional valuers, and what are the key concerns that this valuation method considers and capable enough solving where other valuation techniques lacks clarity. So before proceeding further, I would like to introduce the host of this service, Horizon Asset. Horizon Asset is offering a couple of services. The very first one is standard real estate broking, where I help out individuals and business owners and business entities to find out the right property for themselves, whether someone is looking for a residential one or commercial or even industrial one. I can help you find the right space for your needs. And the other service that I offer is discounted cash flow real estate valuation, and that is exactly what I'm going to explain you in this presentation as well. And one thing I would also like to consider is that I am representing as the only individual to this service as of now. I have not yet had the opportunity to serve any paid clients, but I'm fully committed to managing the highest standards of professionalism. And if you choose to hire this service of mine or any service from the two services that I've mentioned before, I can guarantee that you would not face any sort of unprofessionalism throughout the transaction. So, first thing first, why exactly discounted cash flow valuation method is best? So, the DCF is the best valuation tool because it's most robust and investor focused method, especially for income producing assets like real estate. The DCF is good because of its forward looking approach, where it calculates the future cash flow streams and accounts for their present value to reflect the time value of money, investment risk, and opportunity cost. And we will discuss more in detail about this today's term, time value of money, in upcoming slides. And I would also like to compare some other valuation techniques, including sales comparison approach, cost approach, and gap rate method to to clarify why exactly DCF is best among these valuation tools. So let's talk about sales comparison approach first. So this valuation technique involves comparing the property with recently sold similar properties which are located in the same locality as your subjected property. Let's take an example to understand this. So let's say you want to value a property. Let's call this property A. Your valuer, who is using this sales comparison approach to value your property A, would have to find out other similar or identical properties which are quite similar in terms of providing key facilities and features. Right? So let's say there are property B, property C, and property D. Those properties are quite similar as the subject property of yours, which is property A. And the valuer would see that the property is being traded at some specific price point. Let's say property B is being sold at 96 lakh, property C is being sold at 97 lakh, and property D is being sold at, let's say, 97.5 lakh. So he will average out these comparables let's say the average of these comparables are 94 lakh. So he would be valuing your own subject properties worth at 94 lakh because that is exactly what the other identical properties are being traded on, right? However, there are few limitations that this valuation approach comes along with, and we will discuss not in detail but in a very broad manner. So, the first limitation that the sales comparison approach has is, what if your property subject property is significantly different due to offering something which is not, or let's say, which is not so common to see in other comparables, or your subject property is lacking something which are, you know, easily available in other comparables. So your valuer would be devaluating and adding values based on those specific type of facilities. However, it totally neglects the fact that what if even without even having such a facility which are quite common in other comparables, the property subject property is able to generate more cash flow in comparison with other of comparables. And what if, despite even having such a high class facility method out there, if you are supposed to be investing in this subject property with an intention of reconstructing it from the very outset, it estimates value based on the cost of rebuild the property while also accounting for its appropriate depreciation. The formula is land cost plus cost of reconstruction the property minus depreciation. Okay, so the reason why I told this valuation tool as the best valuation method out there if you are planning to reconstructing the house is because this valuation tool accounts for or machinery required to rebuild the house. So it accounts for all of their expenses. And it's really important for you to consider all of it if you are planning to reconstruct the house, right? So that is why I said about this valuation method as the best valuation method out there if you are planning to reconstruct the house. Now the third valuation technique, which is cap rate, right? So that is the key limitation of this valuation method. And discounted cash flow valuation method solves all these limitations that this valuation technique has, is right. So why DCF even stands out? So the very first reason why DCF is most uh, valued method among professionals is because of its forward-looking approach, where it accounts for rent, expenses, purchase price, rental growth rate, expenses, growth expenses, annual expenses, gross expense rate, vacancy loss data and its rate, and credit loss data and its rate, and also the future sale method is best because it's totally cash flow based. And the most beautiful part of this valuation technique is it considers time value of money. So the time value of money is a core financial principle that states money available today is worth more than the same amount in the future because it is potential earning capacity. In simple terms, it accounts for it accounts that 1,000 rupees today is more valuable than 1,000 rupees received a year from now because you can invest it now and earn interest or returns over time. Okay, so I'm going to give you an example of a commercial office space to help you understand this valuation technique in more detail. And I also want you to focus on some key figures, including disposition costs, right? The discount rate and the resale price or the terminal value, because these are the key assumptions and has a very significant impact on the overall valuation. So suppose these are the financial records of this subject property. It manages to generate 10 lakh rupees every single year after accounting of all of the necessary expenses required to operate the property. And you are planning to hold this investment of yours for next 5 years. And you have your own, probably of your own for 5 years. Or maybe you have seen other professionals using the same strategy. They often buy an asset and hold it for at least 5 years before proceeding with it to sell it. Or maybe you have some other personal reason 5 years. Let's say you want to get yourself retirement after 5 years, or probably you're planning an immigration along with your family after 5 years, or you want to afford future educational expenses of your children and you are going to be funding by selling this asset of yours. Or maybe you have some other specific reasons to hold this property for at least 5 years and you are planning to sell it after that. And you're also planning to or expecting at least 10% as an annual return, probably because you have seen so many other asset classes producing the same amount or same percentage as an annual return. You have seen professionals investing in the financial markets and gaining at least 12 to 30% as an annual return. Or probably one of your own acquaintances has a significant investment in commodities and give you a very broad presentation of the processes involved in this valuation technique. So the very first is where we account for net operating income while accounting for all of its necessary expenses included. And we not only do that for first year, but up until the holding period of yours ends. So in this case, it's 5 year. And the second step is where we account for the terminal value or the resale value. And the way we do that is either by using the perpetuity growth method or exit multiple method. All of these two methods are kind of a technique to account or finalize the terminal value. I personally use the exit multiple method because of its ease of use, right? And the way we do that is by accounting the final year's net operating income, and then we discount them back to today's value to reflect the time value of money. And we also discount the net operating income of each year in the first step. The third step is to sum up the discounted terminal value along with operating income of each and every year to value your investment. In this case, it is approximately 1 crore 12 lakh 44,430 rupees. So, property which is having this numerics as its financial records is worth 1 crore 12 lakh 44,430 rupees based on discounted cash flow valuation method. By doing so, you get yourself a conclusion that this discounted cash flow method gives you a very realistic and investor focused valuation method where it accounts for cash flow streams and their timings. And it helps you not only rely on static income figures, but potential of properties earning potential capacity. Then we finally conclude the interpretation, and there are few things that you should be considering when you are then having a final valuation of your investment. So the very first thing is you are looking your investment based on its capacity. Even though your property was 1.2 crore in your exit year and generates 10 lakh rupees as a net operating income, but you're not watching it based on its, you know, you're looking at it based on its own earning capacity. It's like where you want to employ someone and you're looking at the candidate by and judging him or her by looking at its own capacity to generate and comparing the candidate with other of your professionals and valuing him or her. You're valuing his work based on his work itself. And the second thing is, which is very important, is that it helps you to make a very realistic decision. Decisions are data driven, not some hypothetical situations